Will Jerome Powell go down as the worst Fed president ever or the best? Again, his term, roughly speaking, has about 13 months left. As I understand it, it is over in March of 2026. We're going to have this conversation with the one and only and great Anna Kelly. How you doing this morning, Anna?
I am doing great. Always better when you call me the one and only and amazing Anna. Nice little ego boost after being mama and not knowing anything compared to Chat GPT.
Oh, that is so funny. That is so funny. Well, we've been talking, we were just talking off air. We've almost done 500 episodes together. It feels like Jerome Powell has been a part of a lot of those conversations. He's had lots of
Yes.
twists and turns, up and downs. But if I were to ask you right now, where do you do you think Powell is doing a good job? Let's talk about Powell right now, and then we'll look over his career. But where do you think Powell is doing right now? He's actually speaking as we're recording this.
He is. I actually listened to the whole first hour of his talk to Congress because that's what I do, right?
That's exciting to you.
It is exciting. It's like, okay, where's the nuance hidden in the Fed speak, and what is he saying to Congress versus his press releases, right? So, I think generally overall, although I do blame in part the Fed for being late to start reacting to the huge increase in inflation that they called transitory. That was a big mistake. Let's just call it what it is. But since then, much to my chagrin, because I haven't liked it as a commercial real estate investor to have high rates be high for long, I think generally speaking, if you're just looking at the aggregate data of the economy, that we have low unemployment, we have positive GDP, and at the aggregate, you could say we basically have pulled off a fairly soft landing, no major banking crisis, because although that started and there were 3 fairly large banks that failed in short order, the Fed and Treasury did come in and react to save that from becoming a huge bank run and banking crisis. So they averted a savings and loan type of crisis.
Yeah.
And at a whole, I think if you're just looking at aggregate data, which is what historians typically do, did we have a financial crisis as the result of the Fed's moves, or was it fairly benign? Even if we had a mild recession, I would argue, as you know, and many of our watchers know, that we are in recession, although he flat out today said, no, we are not in a recession. The middle class has been in a recession. We've had these rolling recessions, but by and large, at the headline, we're not in a recession. And if we don't move into a recession that's long or deep or broad, diffuse is the technical term, then I think he will go down in history books for having pulled off the first real proverbial soft landing after such a large increase in interest rates. So I'll give him props in terms of what he has been able to do, and the rest of the Fed governors. Time will tell. There's a lot that could happen and go wrong between now and the end of his term.
Sure.
I still think, we've got some risk of some banking failures ahead. In fact, I just saw in the news yesterday morning that another bank looks like it's in trouble. And so, I think time will tell over the next year. I think we will have that recession call this year. I really do. And that could, be a mark against him, an X, along with all the check marks. But by and large, given the fact that if historians are really looking at what he had to deal with, just like, they went back and looked at Paul Volcker, they're going to say, hey, inflation went up high, rates went up high under him, but ultimately he got us out of inflation. And the books written about Volcker are very clear that it wasn't his fault we got into inflation, but he did the right things to deal with it. So I think fiscal policy is a larger reason, along with monetary policy, that we got in it in the first place. So he could take part of the blame for that. But I think by and large, he's done a pretty good job getting us to where we are today. And it's surprised me that it hasn't been a harder landing. And for that, I think we have to give him props.
Yeah, it's funny. You bring up a lot of great points that I just want to kind of reiterate. First, this is kind of like a midterm grade because you're
Yeah.
absolutely right. 13 months is a long time in monetary policy. It's a long time in the
Yeah.
economy. So it's definitely not a final grade. But if I just look at the scope of work that he's done today, you've got to put him up there with Volcker, right? I don't think he's ever going to take Volcker down as the number one Fed chair. But he's actually done, to your point, a lot of great things. And you could argue it was blind luck. It's funny. I talked to Tom Nash, a big stock YouTuber, yesterday, and he's like, Jerome Powell fell into whatever, that lingo, but, fell into the right decision, right? No more cutting was really the discussion.
Mhm.
And it doesn't matter if you're at the top of the mountain and you got lucky, you'll still go down in the history books as the guy that was at the top of the mountain when we got there. And you're right. If he's able to engineer the first soft landing, which only history will tell. Crisis that we thought was coming did not come. I think both you and I talked about that. And we had Silicon Valley Bank, Signature Bank, First Republic, I think was the third, and that was that mountain, that momentum was looking ugly. And I think
Yes.
since then we've only had like two or three little banks, like tiny banks go. One was for fraud, so not really, similar to this. But you're right, there is still the threat. I mean, I think I said one time there could be 300 or 400 banks that get consolidated because they're just so focused on commercial real estate in their part of the world.
Yeah.
So that threat is still there, right?
Yeah.
The
And those
extended
consolidations don't get headlines. We had a pretty large regional bank here that had to merge because it was failing. It didn't hit, it has failed, but it was kind of taken over and
Yeah.
merged. So you're going to see some more of those kind of mergers and acquisitions that are kind of honeymooned and brought together, married by the Fed. But again, we haven't had the crisis yet. And so, that we got to give them props.
Yeah. And then the other thing that I wanted to hit is, I have been watching Fed speak since Alan Greenspan, the guy who said lots of words but said nothing at all.
Yes.
That's kind of Greenspan. I think Powell deserves credit for, frankly, being remarkably clear. Right. Going back to his Jackson Hole speech, which he threw away and then delivered a 6.5-minute speech that basically said pain is coming, which some people listened to, some people didn't. And I think Powell deserves some credit for demystifying Fed speak. I think, again, he's never going to be, extremely clear, but when you compare him to other Fed presidents, I think he's been remarkably clear.
Yeah, for sure. He's come out and made some statements that people were, quite surprised that he said. Even things like, where are we going? I don't know.
Yeah.
I don't know. He said that in his last press conference. And it's the first time they didn't just try to, that I can remember that, oh, we have this all figured out and we know exactly what
we're the masters
doing.
of the
You need
universe.
to trust us. This is complicated. Yeah. Inflation surprised down and surprised back up, and we don't know the result of the tariffs, and we've got to watch. And so they've kind of admitted that they're in reactionary mode because of the complexities of things outside of their control and because of a change in administration that could lead to very, very different fiscal policies. Having both houses, the House and the Congress, the Senate and the House, both parties of Congress, as well as the presidency, I gave him props that he said, these things we have to watch and we don't know. Now, I think that there will always be those that, blamed him for too much forward guidance and then having to backtrack. Hidden in Fed speak is forward guidance to the bond market and to the stock market and to basically to the markets to say, we're letting you know what we think we're going to do so that you don't have a market meltdown and freak out that could cause an economic widespread, devaluation of assets that could make us have to pivot before we want to. So, they've at least kind of thrown in there key words like, we've made significant progress and we believe we're too tight and we likely are on a path to start to unwind that. I mean, they basically said that. And unfortunately, right after that, inflation readings started to tick up and they had to kind of back off of that. And people blame him for some of these mini little starts of a bad stock market day, because then they did something different than they kind of guided that they would do. But I give him credit that at least they are, more of the Fed governors are also talking outside of, their blocked time period where they can't say anything right before their meetings and they make decisions. But I think that both Powell and some of the governors have been more open to talking to media to give their differences of opinion as well. Or under Greenspan, I remember reading the book Lords of Easy Money, where they interviewed Tom Honig, and he's been an FDIC president. He was a Fed governor, and he was like, it was like sacrilege to come out and say and even vote against Greenspan or Bernanke, because we had to have a unified front. We all had to be 100% unanimous. And this, set of Fed governors has been available, and they've not been afraid to say, we don't have full agreement. We have different views and we don't know, and this is unprecedented, but we're working together to be very data dependent and come together to do the best thing for the American people. So that level of transparency is something that I've appreciated, that they haven't been afraid to say, we don't know, we're working together, we've got a wide range of views, and we're just watching. And so I think you have to give him credit for that. It's something that we haven't seen before in a Fed president.
Yeah, the last thing we'll talk about, I think, is the elephant in the room on the downside, and that was the call of transitory.
Yeah.
That is something that will be hanging around his resume for a long time. But I actually did a bunch of digging on this years ago. What I actually think happened, and again, we'll see if a book is ever written, is I think Powell, for the first and only time in his presidency, he listened to all the PhDs at the Fed, right? Because obviously the Fed's got all these PhDs, and I believe he listened to all of them, showing all of these, models and other crap that inflation was going to be transitory. I never felt that Powell actually believed that, but I also think he didn't really have an opinion because, again, to your point, he didn't know. Right. So for a time, he kind of echoed what all the smart PhDs were saying who live, on Excel spreadsheets and the like.
Yeah.
And that bit him in the butt. And it'll be interesting if a book ever comes out where he talks about that. Because I'm still not convinced he believed it, but it was the best answer he had because he just didn't have the data.
Right. And like leadership in anything, whoever's the buck stops there, they've got to take responsibility and the blame for it, whether they, did it in good faith or not. I think part of the issue, and one of the interesting things is Powell, I think, is the first attorney that has had the job. He was not an economist. I mean,
he's not out of Wall Street. Yeah, he's not
exactly. And so, I think that gives him some less bias into, hey, I've got to look at all of the data, listen to all of the people, and try to form an opinion and lead accordingly. But it is one of those things. It was a big issue. And I think if there is something negative written about him in history, even if we don't have a recession, it's going to be what's happened to commercial real estate and how that has impacted the banks and how it has destabilized. Because as much as we blame, the commercial real estate investors, and I'm a commercial real estate investor, right? So I'm talking understanding the impacts as well as where blame is, does lie. Anytime that you've got such a huge percentage of the investable world invested into something like apartment buildings, like office space, et cetera, when you come out not only making the mistake that it's not transitory, but you do say it is transitory and we will not be raising rates, that allowed the banks to be comfortable having lots of U.S. treasuries on the books more so than they needed to, short-term treasuries that they thought they could roll and not go as long duration because they thought that rates would stay lower. And it allowed commercial real estate investors to have the confidence to continue to do deals and take short-term loans like bridge debt. And those two things combined have created serious systemic risk, although the fallout we have not seen and may not see because of some of these, these things like the Bank Term Rescue Funding Program, and the fact that they have encouraged, Treasury and the Fed have encouraged and allowed banks to extend and pretend, roll your loans a little bit longer. Don't call them due, even though values on paper are below your LTV requirement from when you did the loan. So they've done some things to try to correct and backstop that, which is good. But I do think that if commercial real estate, if rates don't come down fairly soon in the next year to be reasonable to allow this big refinance wave to be refinanced without just significant defaults and foreclosures in commercial real estate. And if banks start to fail as a result because it impacts their balance sheets and makes them illiquid, that will be the biggest mistake that Powell has made and will be blamed for, not because of where interest rates ended up landing, but the fact that he gave forward guidance to the investors and the banks that we're not raising rates, and therefore the actions they took depended on that. And so that's why it's hard for me to say that, hey, it's easy for me to say we're not done yet because we haven't seen the fallout of that. And some of that will depend on how quickly they are able to lower interest rates and whether that extending and pretending and that holding the bonds to maturity rather than making them available for sale actually makes it through unscathed because rates come down and allow them to let all of that roll off the books and refinance it. So that's my biggest, mistake. That I'm still like, I can't give them credit for that yet because it's caused significant pain throughout the economy, and it could cause credit to really seize up this year if rates continue to stay high, and that can become systemic and cause us to not have the growth that we need commensurate to keep GDP above recessionary territory, depending on what inflation does.
Yeah, so let's talk about recession for a minute, because again, this is something that both of us thought would have come and frankly have been wrong about, right? We called it a couple of different times, and when I look at 2025, the year we're in now, I don't see a recession, in the horizon. So we're definitely opposite sides of that.
Yeah.
We have talked plenty about rolling recession. We've talked about some segments of the economy, frankly, being in a depression. But when you look at the totality, it's hard to get there when GDP is up 3%. At least that was the last report that I saw. And net, a lot of the proposals by the new administration are growth oriented. Now, it's going to be noisy. It's going to be chaotic, as I've warned people for months now. But even Goldman Sachs CEO came out this morning and said that, the Trump administration is going to be growth oriented.
Sure.
And President Hammack said this morning, or maybe, it was this morning, you've got to look at the totality of the Trump administration's policies, not any individual one.
Right.
And I just don't see a recession in the offing, at least in 25. 2026 is light years away, but I don't see one in the short term anyway.
Yeah, where I think our biggest difference is in the way that we're thinking. I mean, clearly we've had rolling recession, so I think we should get some credit. It's not that we haven't had any recession. I mean, manufacturing's in recession, housing is in recession, and historically, those are the two industries that keep you booming and that go bust first and lead into a recession. And the reality is all of the data has showed us for more than a year and a half, close to 2 years, since 2022, when we actually did have 2 quarters of negative GDP, was historically recessionary. It wasn't called, right? But we've seen these rolling recessions for sure, a middle income recession, for sure. But at the technical aggregate level, it hasn't been. And something that I'm digesting, right? And I listen to lots of economists, so I didn't just come up with like, we're in a recession on my own. I'm looking at the data under the hood. And I think, a lot of economists are coming out today, and they're still, those that have been around before modern monetary theory was, the rule of the day. So these older economists who look at a lot of, data, a lot of the macro and a lot of the micro data, it's being surprised at two things. One, just how long the lags are of money availability from pre-COVID. And so there was still so much money into the system, especially in the wealthier 20% of the economy that's propping it up, because they're not only getting, they not only got money, but they've got stock markets that have done well with the level of irrational exuberance and just the level of money that's come in from retail investors over the last couple of years, that historically the markets were driven by, large institutional investors, far so more than passive investors or retail investors. The other thing is being surprised by the amount of immigration that's come in. And that level of unprecedented immigration has resulted in more spending. So, regardless of where you are politically, not even going there on whether immigrants should or shouldn't be allowed here, illegally, legally, all of that. The reality is they have spent money. They've made money somehow, but they've spent money. Now you can argue, have they spent more than what they've cost us? And that's a whole nother discussion. But when all of those people are here and they're working and they're spending money, it does prop up GDP and consumer spending somewhat, even if the per capita isn't, they're not included in that per capita measurement of the data. And then the third thing is the unprecedented level of fiscal spending by our Congress that has kept GDP positive when the private sector is in fact in recession. And I think that's where I get a little more nuance, that I can say, yes, Michael, at the aggregate, we have positive GDP, we have low unemployment, and historically that means we're not in a recession. Will it be called? I may agree with you that it might not be, unless things continue to deteriorate. But the reality is the data has been, the GDP number that has been positive has been created by significant government spending. So the number that I heard two different economists say in the last couple of weeks is that we spent 7.5 ballparks, a little bit more than 7.5% of GDP by the government last year to get a 2.5% handle of GDP growth. And so the private sector growth was actually negative, which we've always said is a recession, but the government boosted it with government debt and government spending to keep it up. So here's the thing that I'm thinking about when I say, are we in a recession? I still believe we are. I'm not backing down from that. In a real world, is the real world private sector in a recession, Michael? Yes, it is. The data shows that. But at the aggregate, we're not. The question is this: as it becomes more politically expedient, and under Trump and under Doge, for them to drastically cut spending and reduce the deficit, what that means is the positive GDP that we've gotten from government spending, largely responsible for that, that spending is stopping. That spending is going down. Now, it will prop back up as we redirect some of those Doge saved funds into productive activities, to your point. But those things take some time, and Trump's got to get Congress to agree on that new spending. So right now they're really arguing, we can't afford new spending. The Republicans are split into, we're going to rubber stamp his new spending, and absolutely we are not until we see cuts equal on the other side so that we're not increasing our deficit. So I think there will be a battle there. And whether they agree to new spending or not, the spending that propped up the GDP has gone away. At the same time, the consumers are pulling back. More and more have less money to spend. They are pulling back on discretionary. After our talk last week, Goldman came out and said, hey, hedge funds have mass sold off their equities other than real estate, like in REITs, because they are spooked by discretionary spending pullback, by government spending pullbacks, and the question of what tariffs are going to do to inflation. So I just think that those things, we've not seen the impact of a pullback in government spending, a pullback in consumer spending. And I would argue the aggregate numbers are manipulated. And so, for example, the unemployment rate, Michael, that just came out at 4, it went down. So the markets are like, yes, unemployment's down at 4%. It's incredible. I have to give credit. George Gammon on Rebel Capitalist is where I just listened to this video and heard all the details of the data. I'm going to butcher the numbers because they're just high level in my head and I haven't written it all down yet to dissect it. But he went out to the Bank of Labor Statistics, the BLS, and their number, the report that underneath that 4% says, we've just made an adjustment to our unemployment calculations that show last year we had 2.6 million undocumented immigrants that were in the workforce. Now, one, we know that it was way more than 2.6 million people. It says of those 2.6 million people, 1.4 were white, 1.4 million, and only 100,000 were Hispanic. Now, we know most of those that came over from the border, Venezuela, Colombia, Mexico, even in their new number, they're not including all of it, right? But they're saying that we have to make an adjustment to the fact that they did have jobs, so that kind of lowers unemployment, but it assumed 95% of those 2.6 million people were employed. And the reality, that was an assumption. The reality is many of them were not employed and were on government assistance. So that they said we have more people here. They're claiming they were pretty much all employed, but then they're saying the unemployment number goes down instead of we had more people. They do say 100,000 weren't unemployed, but if we had 100,000 more unemployed, what should happen to your unemployment number, Michael? It should go up, but yet somehow they said it went down. So things like that, I want to go dig under the hood. I think you should too. I think we should do a show just on that. But it's another one of those examples where just like our unemployment numbers have been revised, our employment numbers have been revised downward many, many times. A lot of the data is manipulated and it looks good at the aggregate. They want us to believe we're in a strong economy. I just don't buy it because I dig underneath the hood. So I still believe that there's enough headwinds against our economy that we will have a recession declared this year. I could be wrong. I've been wrong. The timing is so hard to get. And that's what even the best of the best economists are like, our timing was so wrong because of all these things that are different this time that are not, we can't, even Lacey Hunt, who was a Fed governor, of Dallas Fed says, we can't trust the government data anymore. And I just think we shouldn't become complacent. I guess that's my point. It's not to blame the government or say, I don't believe any of the data, but I think we can't get complacent just because Powell and the news tell us we're in a strong economy. Most people know that that's not true. And a lot of the other data that's been presented in the last several days that I've seen from people like Daniel DiMartino Booth shows that employment isn't as good as they claim. Payrolls aren't as good as they claim. Layoffs are still coming. Future layoffs have been announced. Surveys are saying they're still coming. And I just don't think we're out of the woods and we shouldn't become complacent thinking this is the year that because Trump is in office and Doge is doing its thing, we're going to have a productivity boom that's going to keep GDP above inflation and it's going to keep us out of a recession. I just think that a lot of these policies are going to take time to develop. I am optimistic over the long term. I'm more optimistic now seeing a lot of what Doge has found, that they can actually cut the deficit and cut some spending. So over the longer term, I'm more optimistic now than I was, but I believe that there is still some more short-term pain that we have to go through before you start to see really the results of a lot of these other, big inputs into cutting expenses and getting GDP to spark the new expansion. Because not only do we have to not go into a recession, but we have to not just be flatlined like we have over the last 2 years, kind of stagflationary. We have to find some way to actually get out of the bottom, have a true expansion that really gets the economy booming. And historically, Michael, that takes 2 to 3 years, from the bottom. So I think we've got a little more time and a little more pain to experience. But once we do that, I think we really could have a productivity boom that really helps all of us. And so I'm looking forward to that.
Yeah, it's going to be interesting because, again, I see all the points you're bringing up, and the point I go to is I just can't see the recession in 2025, even with, all the cutting and whatnot that you've highlighted. I think that actually, again, I think it's a timing thing. I think the
Yeah.
pain might show up in 2026. I'll give you an example, right? You've undoubtedly heard about, hey, the layoff notices to federal employees, right? Hey,
Sure.
but what is that? It's basically, we're going to pay you for the rest of the fiscal year, roughly 8 months,
Yeah.
and you don't have to show up anymore.
Right.
Now, why would they do that? It's because the money's already allocated, right? So that will all be impact post-September or post-October, whenever
True.
the fiscal year ends.
Yeah.
And that money is still in the system. And oh, by the way, theoretically, half of them probably will get another job. So they're double dipping
Right.
for 8
And
months.
honestly, it's such a small percentage of employment. The federal employees, it's a blip in the radar. I think it's like 0.1% or something like that.
It's just an example that the pain that you see coming from government getting more conservative is not a 2025 pain. It's a 2026 pain, right? And that's kind of what I'm trying to highlight here, because I think you're on to something. But again, given how at least how I understand the government spending is that once it's allocated for the fiscal year, it's allocated. So,
right. Yeah. For cost cutting, I agree. But for the spending that was done, the massive amounts of spending, most of it ended in the fourth quarter. A lot of it ended in the third quarter. So, I just don't, the level of government spending that has kept GDP high has been so high that it has masked the fact that private sector is already in a recession, right? So a lot of these things, it's not so much what are the changes going to bring us in terms of future cost cuts, government layoffs, but it's like, now that the data should be more real and we're not spending as much, are we technically in a recession, and will it be declared? And only time will tell. So, I mean, you could be right. It could go longer than I've thought, and it could go into 2026. And I can guarantee you, Trump doesn't want to have a recession declared under his watch either.
Of course.
So,
of course.
So, they're going to try to find ways, but I just think the data under the hood shows our economy is softer than what it really is. And, the question is going to be, again, I mean, it's only February. I can't believe we're already in February. But I just, if I had to make a bet, it would be, we get the recession call. It's light and it's late. And here's the other thing. Recessions are generally not called for at least 18 months after they started. They usually only last about 10, but you don't find out about it till it's over.
Yeah, exactly.
And I will argue, I will say this, to play devil's advocate with myself, as much as all of these numbers on the private sector were very, very negative, we do have some signs of hope where things are starting to improve in certain sectors across, when you look at the breadth of the economy. And so some could argue that we were in a recession. It is going to be declared, but we're already starting to pull out of it. And so they will say it started in, 2023. We were in it through 2024. And now we're no longer in it. And that could very well be exactly what we start to see. So it's very complicated, and the reality is, in some ways, if I were Trump, thank God I'm not, right? But if I were Trump and I was handed the economy that looked good on paper, but I knew wasn't good, I would be prefacing the American people and saying, listen, Powell, I'm not going to fire him, but he hasn't done a great job. The economy isn't as strong as they say. He's already said that. And we're in a recession. It just, they don't want to call it, but I'm letting you know there's some pain that I'm inheriting that's coming. But because of that, I need Powell to cut rates. And when you see the recession, you're going to see that I was right. And he's going to need to finally admit it and cut rates. That's what I would do if I were Powell. Because if he has the recession and he can blame it on the prior, administration, the Fed, et cetera, then he can say, I'm the president that demanded that Powell cut rates, and he cut them because of recession. And because he's cutting them, now I'm going to get you out of the recession. You're all going to have good jobs. All of you in the commercial real estate world, you can go refinance your debt right now. I'm going to make Powell keep those rates low, and I'm going to save the banks from collapsing, because they're not going to have to write off their commercial real estate. So, in some ways, having the recession declared could actually be a good politically expedient thing to do. And it could save us from the banking crisis and the commercial real estate come to Jesus moment that probably will happen this year or next year if rates don't fall. So that's just my thoughts on that.
Well, let's talk about commercial real estate for a minute. I had a great conversation with Brandon Turner last week, I think. And, during that conversation, we talked a lot about commercial real estate. We talked about the fact that, Ken McElroy and Grant Cardone and those guys are proving that Class A is starting to retrade at 20 to 30% discounts, depending on who you hear. But during that conversation with Brandon, who obviously is very heavy into mobile home parks and things of that nature, I postulated that Class B and Class C real estate, is frozen. It's not a market today. There's no trading. But what I told Brandon is, if Class A is down 25, Class B and Class C could be down 40, 50, and heaven forbid 60% in some markets. And Brandon said, you might be right. You might be right. So again, to your point, there's a lot of pain out there. And again, if you guys don't know this, a syndication in a Class B or Class C property probably had an equity position at the time of only 30%, maybe even 25, depending on how levered the debt was.
Right.
So if you go into a market where the asset fell 40%, the equity is gone. It's zero.
100%. Yeah.
Yeah. And that's the pain that you're highlighting, right? If the commercial sector doesn't get a refinancing wave to kind of recapitalize, that the banks are going to take it on the chin.
Yeah. Yeah. And I've said, several times, like, I think we're only in about the third or fourth inning, we're nowhere near the end because again, because banks were encouraged and lenders were encouraged. Number one, they didn't want to fail and have to write off the asset, but they were encouraged by the Fed to go ahead. We're going to look the other way. We're not going to say, why did you allow these people to extend a year when their LTV was below the loan amount? They're going, as long as they're performing and they're making their payment, we're going to allow you to extend those loans. And so the question is, does that run out? Do the regulators say we just need to wipe off the debt and we're going to come and rescue the banks in some way? I just don't know. But the reality is a lot of these lenders that extended for a year, a lot of them are bridge debt lenders. So, there's a lot of regional banks and a lot of bridge debt lenders. The ones that are most at risk were done with bridge debt because, again, a lot of people don't understand that most of the commercial real estate that was bought over the last couple of years was not bought as buy and hold investment. They were bought to be a 2 to 3 year flip. And just like you flip a house, you're flipping an apartment building. So it's called a value add deal. And the idea is you get in, you get out, and you're out in 2 to 3 years. So you do a loan that's a 3-year loan, and you maybe a 2 to 3 year loan, you might get 1 year extension. Well, they got their extension and now there's no way to extend. Well, these bridge lenders have had to take back a bunch of properties. A lot of them are becoming insolvent. So they're not going to be able to extend them again. And regulations might not allow them to do so. So we've got a lot longer to go on that. And he agreed. I listened to it. I was shocked that you interviewed him because you hated Brandon Turner. But I loved that you were able to have that dialogue and that he was able to kind of, let you give him a little bit of love and love back. It was a very mature conversation between men, and I enjoyed it. I've known, I've waved at him. We've traveled in a lot of the same circles, but I also know that he got in at a time when things seemed to be really good too, and he's got assets in Austin, and Austin's taken a big hit on paper, and he said it's a struggle for us to just maintain because of all of these changes, not just the interest rates, but the overbuilding and then having to slash rents because of concessions from all the overbuilding. And so, I think he, like myself, says, over the long term, multifamily is a good asset. We still need more of it. But in the short term, especially in certain markets, if you were in that value add, which are the Class B and C deals that you're trying to bring them up to look like brand new properties to compete with Class A, once those are, those are the ones that haven't seen all the fallout, and they're the ones that aren't trading, because big hedge funds can come in and buy a Class A property for cash. It's an asset preservation play for them. And they're buying at a big discount on paper, right? Hoping that when rates normalize and go back down, those cap rates are going to go back down, meaning their value is going to go way up. So they're getting into them knowing, this is pain. This is like the GFC for commercial. Let's go buy these distressed assets, hold on to them for a few years, and they're going to be worth a lot of money. But the B and C stuff aren't bought by these institutions. They want brand new that they don't have to deal with any maintenance or vacancies or whatnot. So B and C relies on small syndicators like Brandon and myself, right? We're small fry compared to these big institutions that are buying the Class A. And if we can't get a loan for any better than 65% LTV at 7% interest rates, we can't buy anything unless we get it dirt cheap below an 8, 9, 10 cap to give us the premium for buying those things. So the credit markets are so dried up for B and C that even if buyers want to come buy them, they can't right now. So there's still a lot of pain ahead there. But I think if you can take advantage of that, like I'm trying to do, like you've said you want to do as well, not take advantage of people, but the reality is they're losing the properties anyway. The bank's going to take them. And in some cases, the banks are taking them and they're not selling them. They're holding on because they know these assets are going to be worth more in the future. And so, there's opportunity for us to go in and buy distressed Class B and C. And instead of trying to quickly value add, you buy and hold them. You put on a long-term Fannie Freddie 10-year, loan on those things. And then when the economy does rebound, as it always does, and values go back up, then you sell them at that point.
Yeah. Yeah. The last thing I want to talk about here is I also had a conversation with Grant Cardone that just published yesterday evening. And one of the things that we talked about in there is this is going to be perhaps the greatest wealth creation opportunity, again, commercial real estate, Class B, Class C, that we talked about. The one thing that Grant said that really did get my attention is he's like, yes, you're right. But at least in his opinion, the window is going to be rather small. And that actually got my attention because, I was kind of coming into this thinking it might be, a 3-year window of opportunity. And again, according to Grant, one guy's opinion, he thinks it could be short as 18 months. So,
yeah, I agree with him there, Michael. I really do. The only thing that can make it a little bit longer is how long does it take for some of the banks to start letting them default and putting them back on the market, right? If they do it really quickly, especially if credit markets open back up and interest rates are low, that will be a short window of opportunity. So because my thesis is we are going to have some pain, enough pain to at least get the Fed to start lowering rates. They've admitted they're above neutral. They've admitted they're still restrictive. So if they can get rates down even 1%, that's going to open up a lot more buyers to be able to go in. And if banks maintain that 75, 80% LTV and the economy starts to bounce back and the stock market, rallies again, and people feel good about being in an expansion again, if that happens, once they're in an expansion again, you'll still have a lot more properties trade. The values will be a little bit higher. But if you can go in, the short opportunity for me is as the Fed cuts rates, if we believe a thesis that inflation will be higher or rates will go back higher after they're cut because of some pain or recession, then you've got a short window of opportunity to go buy at historically low prices and a lower interest rate again before both the values and the rates start to rise again, and make that opportunity for generational type slam dunk deals that have huge upside, that they minimize that. So you've got a short window to like really get best rates and best prices before things start to kind of normalize again. And there will always be an opportunity for good deals, but the kind of deals Grant wants, the big deals, the kind of deals Ken McElroy wants to go after, these big funds. It's like, we want to get them while they're historically low because we know the real value of these things is way higher than what paper reflects today because of artificially high interest rates.
I love it. Well, the good news is we're going to keep coming back each and every week to have our discussions. We've been doing this for 4 or 5 years now. If somebody wanted to follow you or reach out, how do they do that?
Great. You can follow me on social media at Anna Kelly REI Mom, both my personal page and my business page. If my 5,000 friend limit gets you under the weather. And you can find me if you're interested in real estate coaching or consulting, a review of your portfolio, a review of investments that you want to consider. You can reach out to me on my website at AnnaKellyInvesting.com to get on my calendar.
Thank you so much. Have a great week.
You
Bye.
too.